Yeah, I think we're still in the meltup, so it's really kind of the same story that I've had. But obviously, yesterday surprised some people. I had actually posted the night before, the day before, that I saw a setup where you could get, a 5% pullback in the S&P and maybe a little more than that in the Nasdaq, and we certainly got that. I think it's just a case of so many investors, both professional and retail, um, jumping on the bull bandwagon just because it's run so far and the momentum is there. And they're not there with conviction. They're just there. They're there because of the momentum, FOMO, if you want to call it that. And so you get a little bit of a rollover and they react. So I think yesterday basically rebuilt the wall of worry in one day. We've been for most of December we've been in a sell off, so it's not like yesterday was a one day wonder, but it was coming down very gradually, and then obviously the with the Fed meeting yesterday, people reacted to the comments from Powell and gave him an excuse to sell. I don't really think yesterday Powell said anything that was surprising. But again, the market looks for an excuse when it's overbought or when it's kind of nervous. So I think it was kind of the pause that refreshes. It was I don't expect a lot of downside from here, and I think basically we'll get a year-end rally, and that should carry on through into January and be much higher than we are today.
What do you think shocked or surprised people from what Powell had to say the other day?
Yeah, I think it's funny because we really had led up to this saying, this is probably going to be the last cut for a little while. He's going to, it was pretty much telegraphed he was going to do or the Fed was going to do a quarter point cut, but then take a break and kind of watch the landscape and see whether inflation calms down again. It's ticked up a little bit, as you know, in the last couple months. So that was expected, and that's kind of what he delivered in his press conference. I'm not sure exactly what phrase he used that got people panicked, but basically the expectation going in was that we are going to have four rate cuts in 2025, and he kind of indicated, or the dot plots indicate, that they're probably more likely going to be two. That's to me it's silly because you go to the next Fed meeting and it could be back up to four. It really is a point in time judgment. It's not I wouldn't put any faith in their ability to forecast rates or
Snapshot.
the economy. So, but I think that's kind of what spooked the market. Like I said, the market was needed an excuse to go down, and I think it got it. But as you see today, it's right back up. So, yeah, I never know whether the actual bottom was yesterday or whether we'll fool around for another few days. But I just don't think there's a lot of downside risk in this market.
Interesting. When you look at the Dow, for example, and I'm sure you're well aware of it, we had 10 consecutive down days in the Dow. And then if you look at the breadth indicator, which is winners versus losers ratio, um, I believe we hit somewhere along the lines of 12 consecutive days or 13 consecutive days. So what do you make of that? Is that an early warning indicator of any danger to come?
I think people are overreading it, frankly. It's interesting because when you get these things that haven't had that many down days or that many days of breath deteriorating since 19 whatever 74 or whatever number they threw out there, date they threw out there, and it catches people's attention because they think, oh, breath is beginning to deteriorate, must mean the market's getting long on tooth, must mean we're at a top or very close to a top. I don't think so at all. We basically had, people forget, we had a very big run from the early August, when we had the carry trade scare or the carry trade unwind. From there, we've had a pretty straight up market with a couple of corrections along the way. And so, having several days where, the small cap like the Russell had a nice run, it was consolidating. The cyclicals and value stocks were consolidating, and you still had some strength in some of the Mag Sevens or some of the tech area, the AI, et cetera. And it just gave you the look that boy, this market's really narrowing and breadth is falling off. And that's usually a sign of deterioration. In this case, I think it's really more step back and look at where you came from, understand that we were just in a consolidation. You're reading too much into that consolidation. So I don't think it's what people are reading into it at all.
What do you see lying ahead for 2025? What are your expectations for the year?
I think we are, the economy, despite, I mean, leading indicators were positive today for the first time in, I don't know, a couple of years at least. Um, and in spite of that, in spite of, GDP, the revised GDP being up nicely, still showing pretty good growth. In spite of that, I still expect that 2025 is going to be a slowing economy, moving into a recession, ultimately moving into a global bust. Um, I don't I don't think it's imminent. I think you could get through the first quarter and still have positive GDP. I don't know that. I mean, it could go either way, but I think we are slowing. And you still have this have and have not economy where, obviously home prices, in spite of the fact that they may be topping out, are very elevated, and markets elevated. So people on the upper end of the scale, the top half of the scale, have tremendous wealth and plenty of money to spend, and so that part of the economy is doing okay. But then you've got really half the economy or half the population that's in that have not category that are just trying to get by. And I think the longer, and Paul even admitted they're still in restrictive territory. They may be getting closer to neutral, but they're still in restrictive territory. And I personally think they're more restrictive than they even think, by quite a bit. Really, this policy it's going to look okay until it doesn't, and then all of a sudden you're going to say, "Wow, we overdid it on the tight side." That's typically the way the monetary policy works, anyway. Is the Fed's backward looking by definition? They look at data, and so they're not going to be ahead of the curve, and it's only going to be in reaction to an economy that's not doing well that they're going to finally wake up and say, "Hey, we got to get a lot more aggressive on the easing side." I expect that to happen sometime in 2025. Whether it's in the first quarter or not, we'll have to wait and see. But I think that's coming. I think, as I said, a global bust is coming. I don't know what quarter or even, certainly don't know what month, but probably out towards the middle of the year is my guess. And you've got still plenty of room on the upside in the markets until that becomes a clearer story.
Talk to us about the breadth of this global bust that you anticipate. How deep of a bust are you anticipating? And just go into a little bit more detail for those who may just be coming across
Sure.
that phrase
Yeah.
for the first time.
First of all, I define a bust as something bigger than a recession, but not drawn out like a depression. So it'll be, 2008-9 was pretty close to a bust, not quite a bust. This one, I think, will be, we'll go over that cliff that we almost went over in 2008-9. I think it'll be steep and relatively fast. Relatively meaning it's contained within a 12 to 18 month time horizon. Kind of the length of a recession. And it's a bust because we have tremendous leverage in the system, both in terms of global debt being at 320 or 25 trillion, and derivatives being notional value derivatives being in the quadrillions. We just don't have leverage. We've never had leverage like this before. When things start to unwind, I think that just is going to speed it all up and make it much worse. It'll be over in a matter of months or a year. But while we're in it, it's going to feel worse than anything we've been in the post-World War II era. So you could have some major bank failures, more overseas than here, but certainly, the big banks are all intertwined. There's plenty of counterparty risk. So if we see bank failures in Europe or in Canada or in Australia or in Asia, you can bet that our banks are not going to be sailing through that. So I think people, on the one hand, need to understand it's not imminent, that there is going to be still a pretty long bull market run here. But on the other hand, they better be on this side of it and not get caught in it, because the downdraft is going to be, I think, pretty serious.
Hmm. Are we not already in a recession, though? I mean, typically these recessions are retro. I mean, they're announced retroactively, right? Could we
Yeah,
already
that's a
be in
good
one?
point. I made the case starting last summer that we could be in a recession already, and that when they go back and date this after the fact, these things aren't determined until after they're over. When they go back and date it, I think they'll find it started much sooner than they thought. It's hard to argue we're in a recession right now when you look at the consumer as strong as he is, and when you look at GDP as strong as it is right now. And that's why I kind of use that discussion about have and have not economy. For sure, manufacturing is in recession. For sure, half the population feels like they're in recession. But whether technically we'll go back and date it and find we were or not, maybe a moot point. I'm not sure. Like I said, I think we're going to probably see a more of the same, what we've seen this fourth quarter, in the first quarter, but with slowing. So, GDP may not get into negative territory in the first quarter, but it certainly will slow, in my opinion. I think a global, I'm calling for a 80% bear market to accompany the bust. So
Wow.
the bust refers to the financial system and the economy. So there's going to be a big bear market. In a global bust, most assets get hit hard. I think it's going to be a deflationary bust. So, assets will be deflating, but so will basically price levels in the economy. So I think gold probably gets hit along with most assets. Won't be like the stock market. If the stock market peak to trough goes down 80%, gold might go down 40 or 50%. Silver, on the other hand, is much more of a cyclical metal and much more volatile. So I wouldn't be surprised if silver, dropped closer to what the equity market's doing. And my numbers on the metals, I have gold going to 3,400 now, before the bust. So if you drop, and probably won't even be 40 or 50%, you could drop back, say, to 2,100, which would be basically a 30, a one-third retracement, at 2,100 being where we broke out. So I think that's probably what you're looking at in gold. Silver, on the other hand, I have a target of 75 pre-bust. And if it, gets hit hard, you could see it back to, the mid 20s again. So, basically that'd be two-thirds, hit.